So what we are discussing is that we have taken three actual uh, net sales, right, and the other income, and then we added it to the total revenue. We got this revenue, right, and we calculated the actual growth of revenue in the first year from between 10 to 11, 2010 to 2011 it is 3.4%. From 2011 to 2012 it is 6%. Then 13, 14, 15, 16 and 17, these are estimated because it is, you see it is written here estimated. So in estimates, uh, the analyst assumed that in the first year it will grow at 6%, and then gradually the growth will settle down, right? Because as the company will become bigger, it is difficult to maintain the growth rate, right? So ultimately it will come down to 2%, 5, 4, 3, and ultimately in 2017 it will come down to 2%, right? So this is an assumption. This assumption we can change also, right? If we feel that this is a conservative assumption, uh, we can also modify this assumption. The figures will change, but the process is same. We will follow this process. Then we got this cost of goods sold, right? These are keyed in figures. You can see it is in blue, right? You can see here. These are actual figures which are keyed in, right, from the annual reports. And then uh, we saw that it is actually around 75% of the total revenue. You can see the formula here, right? So the cost of goods sold is around 75% of the total revenue, and we are assuming that it will remain like that for next 5 years, right? We can, if we see that it is changing because of change in the economic realities, the market realities, right? The cost may increase, some cost may decrease, but that we can adjust accordingly. But for the creation of this model, our assumption is that it will remain at 75% of the total revenue. This 75% of, and with this assumption, we can calculate the cost of goods sold, right? So it is this 3,55,325, it is 75% of 4,73,767, right? So now this we can calculate the cost of goods sold for the estimated years, right? Now if I deduct this cost of goods sold from the total revenue, what I will get is the gross profit, right? And I can also calculate the gross profit margin, right? The gross profit divided by total revenue, it will give me the gross profit margin. From the gross profit margin, I can deduct the operating expenses. So the operating expense for 2010, 2011 and 2012, they are actuals, right? So I can keep in from the annual report, and then I can calculate the percentage of the this operating expense, selling, general and administrative expense, by dividing it with the total revenue. You can see the formula here. You can see the formula here. So, sorry. You can see the formula here. If I select it, you see, it is the selling, general and administrative overhead divided by total revenue. So you get it as percentage of revenue, right? So as an analyst, I am assuming that it will remain at 17.3% in the next 5 years also, So you see they are in blue color. That means they are keyed in. You can see these are keyed. So this is my assumption that it will remain at that level. Fine. With this, I can calculate the projected selling, general and administrative expenses. So my formula is this. So my formula is this. Here you can see the formula. That is the total revenue into 17.3%. So I am getting this value. Fine. Same with the other 4 estimated years. Right? Other 4 estimated years also it is the same way.
Sir, there's
Yeah.
a question.
Yeah.
Say, for example, when I'm evaluating a company,
Hmm.
so I'm evaluating based on the last 5 years data.
Hmm.
So these are the actual data, and I'm using my analytical skills and giving the opinion.
Hmm.
If the company asks me that what could be their predicted results, estimated results in the next 2 years, 3 years, or whatever.
Yeah.
So there as an analyst,
Hmm.
am I open enough to hold my assumptions like the one which you are showing it to us?
No, one of the basic condition of any financial model. See, the models cannot 100% match the actuals,
Correct.
right? There will be some deviation.
Hmm.
Our goal is to minimize the deviation,
Correct.
right? Later on, we will see when we will do econometric forecasting. There, the
Mm-hmm.
entire play is depending upon the minimizing the error,
Hmm.
right? So ARIMA and all these autoregressive models, the entire game is minimizing the errors, right?
Correct.
So the least is the error, the better is the model, right? Now, why the error comes? The error comes because of the assumptions. The more realistic are the assumptions, the better
Hmm.
will be the model, the less will be the error. And the more far away the assumptions are,
Hmm.
right? The error terms, when I will try to compare it with the empirical data, the error will be large,
Hmm.
right? So for understanding a model, it is very important to go through the assumptions first,
Hmm.
right? It is true for all kinds of models. There are many models we study in textbooks and very popular models, but when you will apply it in
Hmm.
the practical world, the empirical
Hmm.
result may not be that impressive,
Hmm.
right? So there are many examples. Like for example, you can take CAPM itself, right? The capital asset pricing model. It's sometimes its empirical validation may not be very impressive,
Hmm.
right? Because there the underlying assumptions may not be very realistic. Like they assume a rational person, but rational person, a person cannot be rational all the time, right? Act rationally all the time. So I think if you are working for a client or for your own company,
Hmm.
anybody who will look into your model,
Yeah.
right? The first thing they will ask is that actually two things happens, right? You can tell your own result,
Hmm.
like many stock predictors they do. They tell the result and then they see that okay, you see the final result, and then when the actual result will
Hmm.
come, you match
Hmm.
it,
Hmm.
right? That is a different game,
Approach.
right? That's a different game. Sometimes it works,
It doesn't
sometimes it doesn't work, right? If it works for majority of the time, then for some time,
work.
right? Then the analyst can say that okay, see what I have said,
Hmm. Hmm.
right? So that is a different ballgame. But if someone is, if you are doing it for a company, right, as a client,
Hmm.
for example, right, or you are working there,
Hmm.
right, and you are creating the model, and company you is supposed to take a a multi-million dollar decision on the basis of that model,
Right.
then of course they will ask for the assumptions,
Okay.
right? Because it is very important to see that how realistic are the assumptions. There may be many counter views,
Mm.
right?
And it varies also depending on the type of the company and the volatility, right?
No, you are talking about which
You
kind of
know,
model?
I know,
Which
I'm talking about the
related?
assumptions that an analyst will make. Will again depend on the type of the company and the market volatility.
Yes, yes. That is all. See, that depends on lot of things. That depends on, say, that we discussed earlier. That depends on the core competence of the company, the industry to which the company belongs, right? The governance of the company, the culture of the company. So there are so many things, right? There are so many factors that can influence the valuation of a company, right? And it is not a static environment, it is a dynamic environment. So today, a company may look very promising, right? But tomorrow it may not. But today, see, there is no permanent this thing, like once Mr. Nilesh Shah said that Ram doesn't always may not remain Ram always.
Mm.
Ram can become Ravan, right? And Ravan can also become Ram. So in financial world, there is nothing static. Like for example, I can give you one example, like jute industry,
Yeah.
right? Jute industry a few years back, decades, couple
It
of
was a
decades back,
dominant
it was
one. Mm.
considered as a sunset industry,
Dominant, yeah.
right? No one was used to willing in that, and we used to get lot of bad news. Actually, I remember in 80s and 90s we used to get only bad news about jute industry, that company is getting closed down. There's some disturbance, liver disturbance, and all these things, right? But now suddenly this jute industry has started reviving. Why it started reviving? uh, it started reviving because there is increasing focus on
Yeah,
sustainability.
circular economy and all that.
Yes, because the developed economies,
Mm.
they no longer prefer plastic
Yeah.
products. They prefer biodegradable
Sustainable.
products, right? Natural products,
Mm.
and it is a new market for jute is exactly fits into that bill,
Yes.
right? It fits so well, and they're so well accepted,
Yeah.
right? Uh, so it is jute is again coming back
Yeah.
actually, right? Right. If you find a jute company, jute industry company, which is well managed, right, professionally managed,
Mm.
I think in the coming terms it can be a good investment bet,
Mm.
right? And in that way you can help the earth also,
Mm. Mm. Yeah.
right? So you see, there is nothing static. The assumptions can change, but the success of your model, right? Uh, a lot depends on the assumptions as an
Realistic.
analyst you are making. Yeah, and if you are doing it for a client, right? You will say they have every this thing to ask that what are the assumptions you are making. But if you are suppose if you are trying to predict a stock price,
Mm.
right, for common people,
Mm.
right, then you may not tell the assumption. You can say that this is my prediction, just see that what happens,
Yeah.
right? But if you are working in say an investment bank, right, and they are going to invest, you are an employee there, employee analyst there, and they are going to invest their clients money on the basis of your model,
Mm.
obviously they will ask
Hardly.
that what are the assumptions you have made. So it
Yeah.
happens like that. So now you see, now if you deduct all this, you get the EBITDA, right? EBITDA, it is, you see, it is coming 7.6, 7.9, 7.8. You see, it is more or less consistent because our assumptions we made like that, right? It is growing at 7.7%. That is our assumption, right? So it is a calculated value. Fine. Now, the significance of EBITDA we discussed earlier, if you remember. It is quite popular among the the valuation professionals. Can you remember why we calculate EBITDA and why it is so popular? Can you remember? I think we discussed earlier once. Why EBITDA is so popular?
Sir, EBITDA is an indicator now. What is our business?
But we can compare. Ideally we should compare. We can compare earning after tax, right? That is the net profit. But why EBITDA?
No, this is operating profit, sir.
Uh, See, what happens, EBITDA is, uh, when you are, see, I'm comparing two companies, right? Okay. And I want to compare their earning capabilities. Fine. So, EBITDA is what? Earning before interest, tax, depreciation, and amortization.
Amortization.
Right? That is EBITDA. Right?
Mm. Mm.
Now, this interest is dependent upon what? Interest is dependent upon the capital structure of the company.
Borrowed funds.
Right? If you remember, we studied in financial management earlier that
Mm.
if there is a debt component in the capital
Mm.
structure,
Mm.
then what happens? For a profitable company, it gives there is a phenomena called financial leverage,
Mm.
right? Because interest is a
Mm.
tax deductible expense, right? So it increases the ROE, return on equity, right? So suppose there are two companies, one company has debt in capital structure, the other company is debt free, right? If everything else is same, whose return of equity will be better?
Levered.
With debt or without debt?
With it.
With debt,
Mm.
right?
Yeah.
So that means if you compare the, you see the net profit or ROE,
Mm.
uh, by comparing that, you are unable to decide that who is operationally better or who is doing better because it has taken more risk by incorporating debt into capital structure.
Mm.
Are you getting my point?
Yes.
One company may be operationally may not be so good, but it may earn
More
better
ROE.
profit and return on equity because it has taken more risk, because it has issued debt,
Yeah.
right? So this element I can remove, right? If I consider EBITDA, this element is removed, right? The leverage effect, financial leverage effect, it is being removed, right? Then next item is tax. See, taxation is it differs from country to country. Also, sometimes differs from state to state. Right? Again, the same factor. Suppose you see all companies, they want to optimize their tax benefits. Right? So for optimizing tax benefits, they go to those places which offers them tax benefits. Right? It can happen within country also. For multinationals, it happens across the countries also. Right? You will find that many of the this cosmetics and all this Hindustan Lever we were discussing. In Hindustan Lever, if you see that where it is manufactured, HUL markets it, but where it is manufactured, In most of them, you will find they are either in Himachal Pradesh or Sikkim or Daman, Diu, right? These places, right? They give additional tax. There in Northeast, if some company makes the production hub, he gets a special tax benefit within the country, right? So when again you are comparing the two companies, uh, one company may do better because of getting tax benefits, may not be because of its operational efficiency. Fine, okay. So those elements I need to remove. Okay. So I can remove those elements by considering EBITDA. Then comes the depreciation and amortization, right? Again, depreciation and amortization, it is dependent upon what, right? First of all, it is a non-cash expenditure, right? And it depends upon the accounting policy that management has adopted. Suppose there are two companies. One adopted straight line method for depreciation, another adopted, say, WDV, written down value method for depreciation. Everything else is same. Their performance is also same, but their profitability will be different. Yes or not?
Yes. Yeah. Correct.
Right? So, uh, this difference in profitability, the return on equity, EPS, etc., it may be happening because of management policy, may not be directly because of operational efficiency or inefficiency. That element, if we want to remove, right? So what we can do, we can remove that also. So when I am calculating the EBITDA, I am removing all these elements. The impact of financial leverage, impact of tax, policy of the government, and of course management policy of focusing on tax benefits, the depreciation and amortization. Is it okay?
Yeah.
So, for valuers, right, as we discussed earlier also, right, there are two ways of presentation of financial statements. One presentation we make as per the law or the regulations, like following accounting standards. Then there is a specific format for balance sheet and profit and loss account. That is one way of doing it. But as an analyst, when I am doing, I try to get some insight into the data, right? I try to get some insight into the data, and that I can do by working on the data. So that data I can arrange to serve my purpose, right? So many of the things in published information, the published data, they follow the format which is prescribed by the law or the accounting standards. But when I am actually trying to value, right, I may change it. But that is for internal consumption, not for reporting. Fine? Okay. Now with this EBITDA, we can deduct depreciation, right? Depreciation calculation we will see there is a schedule where we will see. and if I deduct depreciation, I get EBIT, right, earning before interest and taxes, right, and from there I can deduct the interest expense, right. There is a schedule for interest expense also, right, you can see here. Uh, you see there is a date schedule, right, you will see that here is the date schedule. We will discuss it, right, how it has been calculated later on. So from here I am bringing the interest expense and I am getting EBT, earning before tax, right. From earning before tax I deduct the tax, right, and I got the net income, right. So this is my net income. From the net income, you see there in the published statement there are some non-recurring events, right, which is given in the annual report, but for forthcoming years I don't have any information, so I kept all it's zero. If there is an information, then I can put it here, but no information is there, so kept it blank. Fine. So I arrived at net income after non-recurring events, right. So this is net income adjusted and then net income after non-recurring events, right. And from here I can if the non-controlling interest, I deducted it, so net income as reported. If you divide this by the number of shares, you can get the earnings per share, right. You see the average common shares outstanding, it is given here, right, you can see the formula. So if you divide the net income by the number of shares outstanding, you will get the EPS for the years, all the years. So that's how we can prepare the first projected income statement, right. And in the forthcoming classes, what we will do, from this income statement we will prepare the balance sheet and ultimately the cash flow. Now cash flow statement is important. If you remember, we discussed that the investors, the equity holders, they are primarily interested about the cash flow, right, because net profit is an adjusted figure, right, but the cash is hard cash, right, it is hard. So any investor, primarily he wants to know that if I invest into this company, how much cash actually may be generated over time, right. So ultimately everything boils down to cash, and we will see later on that basically they are interested in the free cash flow, right. What they are interested is, what we say, it is called free
Free cash flow to equity, right?
Free cash flow. Free cash flow. Free cash flow, first one is to the firm,
Hmm.
right. It is called FCFF, right. And second one is free cash flow
To equity.
to the equity. Right. What is free cash flow to the firm, and what is the FCFF and FCFE? It is that the cash available after paying all the obligations and the cash requirement for the increasing working capital. What happens when the company grows, right? Its working capital need also increases. Fine, right? You have more stock, more data, and all these things, so your working capital need also increases. This work for the meeting this working capital, I need to have a provision for cash, adequate cash, right? Also, I need to service the dates which I have taken. I have to meet all other expenses, salary and whatever purchases. After doing all these things, after meeting, paying all these cash requirements and keeping a fund for ourselves, right? Keep your fund for working capital. What is left for the firm? It is FCFF, right? Now, uh, from FCFF, if you reduce the amount paid to be paid to the providers of debt, then what is left is for the equity holders. That is FCFE, right? So you paid all the cash expenses, you made provision for increasing working capital, right? Whatever cash is left, that is for the firm, so that's FCFF. From there, you deducted the cash needs to be paid to the to the lenders. You paid to them. You paid cash for as interest, as repayment of principal. What is left is only for equity holders. That is FCFE. The equity holders, while valuing the equity, they are primarily interested into this, right? They are primarily interested to know that at the end of the day, what would be the free cash flow to the equity. Is it okay? Do you have any questions? So ultimately what we do is for valuation, right? We calculate, it is like this. Suppose I'm calculating the value of a company, right? So what ultimately I will do is I will do it like this. FCFE divided by 1 plus R. R is the discounting rate, right? Usually we consider a WACC as the base, right? 1 plus R to the power 1 plus to the power 2 plus, so it will continue, right? And for a company, you know that it survives till perpetuity, right? So it will continue like this till infinity. This is the concept of going concern, right? In going concern concept, we see what,
Yes.
we know what, we assume what? We assume that company will go on and on and on, right? Till perpetuity, right? So so it is a kind of, this thing. And for R, for calculating R, I am putting a star here. For computing R, uh, we may take you can take walk as a reference point, then you can add or less, right? You can add some premium or discount depending, again, subjectivity, but you can consider WACC as the reference point, as a discounting rate, right? WACC is what? That's basically the cost of capital, the rate at which you are acquiring the funds. Is it okay? Do you have any questions?